Let's start with the Fed here. I mean, they're telegraphing about 8 hikes for the next 3 years or so. Can they actually stick this landing?
Yeah, that's the $64 million question, Yvonne. You know, they gave us a lot in a short period of time. You know, they went from accelerating the tapering to, okay, hey, everybody at the Fed says we're going to tighten next year, some more than others. And then they started talking about, you know, quantitative tightening, letting that balance sheet sort of run off. You know, I don't think we're going to get some version of a taper tantrum, but it's a lot for the markets to digest in a relatively short period of time. And, you know, whether they're going to be able to do it, you know, ultimately, let's not lose sight. What is the Fed trying to do? Sort of push down inflation, but not weaken the U.S. economy too much. And, you know, they don't have a great track record of being able to do it, particularly when they kind of go fast in terms of tightening monetary policy.
Yeah, and you're starting to see that in the bond market, right? Overnight, you've seen yields slide, and it seems like there's just not much confidence that the Fed can deliver on that. Is there further to adjust then? And where do you look on the curve?
So, yeah, you know, it's interesting. The bond market has been a big conundrum for a lot of real money accounts. I mean, the pain trade is for yields to head lower. I know everybody's position. They look at it as opening of the economy, all this stimulus in the pipeline, inflation definitely coming in higher than expected, yet yields, nominal yields, still are relatively sticky in the long end. And I think it's this battle between secular disinflation pressures and cyclical inflation. And, you know, I think the long end is going to be in a range. I just don't think it's going to do much of anything.
And as we've been talking about this week of 20 central banks, and you have a shock from the BOE, the ECB, some kind of gradual taper, but she didn't mention anything about rate hikes until a bit later on in the pipeline. How do you trade around this sort of central bank divergence for next year then? What is the best way to position around it?
So, okay, the divergence, there's not a ton. I mean, again, I get it. You know, they should be pulling back on monetary stimulus. You know, I don't think, barring Omicron really kind of getting worse, I don't think it will, but, you know, the economy is transitioning from this big recovery to expansion. They should be pulling back on stimulus. They should be doing it gradually. And I think the key is that these central banks need flexibility. They need to kind of withdraw emergency level monetary policy, but don't kind of transition to aggressive tightening too much. And again, I'm more constructive next year on growth. I actually think it's going to be broad-based growth. I mean, you're seeing data come out better than expected in China, in the U.S. and Europe right now. And so I think the global economy can withstand this reduction of monetary stimulus.
And hence, I guess you are seeing this very contrarian call from you about starting to increase your underweight dollar call. Mm-hmm. Walk us through why and what indications have you seen that we perhaps might have reached a top for the dollar?
Okay, so there's two things driving it in the near term, and this isn't high conviction, but I think maybe we're transitioning to, you know, on the equity side, value stocks are doing better than growth. I mean, clearly, you know, you saw what happened on Thursday in the U.S. The big cap tech stocks got whacked. They have absorbed a lot of global capital. They've done very well. If this is going to continue, and maybe it is, I think that capital is going to leave the U.S. in search of better value. Emerging market stocks meet that value criteria. So that's one development. The real development, though, is I actually think what I alluded to a little earlier. I think this is going to be next year, broad-based global growth. And I think an environment where you're firing on a number of cylinders, it's not U.S.-led growth. China steps up, does more. We see that manifest itself. That's an environment where the U.S. dollar doesn't have to be strong. Other currencies should strengthen. Think of it as terms of we're going from drivers of currencies of relative monetary policy to relative growth. And if I'm right about that, I think the dollar could weaken.
I know you mentioned about Chinese bonds, sovereign bonds being a bit of a hedge for you. We've seen that kind of call from many analysts here locally and regionally as well. Do you see Chinese bonds outperforming EM and even U.S. Treasuries next year, and why?
So not not the high beta EMs, the ones that have really juicy high real yields, but Chinese bonds are unique in the sense they serve a couple of different roles. I mean, they're high quality duration. So if we do get stress, if China does a policy mistake, they're going to hold up well. Hey, they actually have a higher yield than what you can earn certainly in core European markets and treasuries. So I like that defensive nature. And then obviously being a global bond manager, our indices now include China. So not being there is a bet against China, which I don't want to do. But I think if we're right about inflation maybe peaking next year, I really think some of those high yielding EM bonds could actually start to attract a lot of attention and capital.
When it comes to China, though, you hear authorities talking about front-loading policies, and there is some speculation out there that may be ramping up when it comes to infrastructure projects here and these faster pace of these special bonds. Do you think that could bode well for fixed income still?
So again, remember, so the Chinese bonds, it's a hedge. So, like a hedge, I don't mind losing money on it because I'm going to make money elsewhere on the more riskier, higher yielding parts of the portfolio. But having said that, it's critical, because my thesis of global growth is not going to happen unless China really kind of starts to go down the stimulus path, lead with fiscal, let the fiscal impulse do well, and then we'll start to see the credit impulse improve, and then that growth should leak out into the broader global economy.